Okay, we will be looking at problem 31, and this may be a two-part video because it's a pretty lengthy problem. But what we're going to do is using a spreadsheet to prepare the statement of cash flows indirect method. Use the Boost Plus incorporated data in exercise EB-31 to prepare the spreadsheet for the 2018 statement of cash flows. Format cash flows from operating activities by the indirect method. So we will look at the information from that problem. Okay, so here is the income statement. As you can see, net income is $53,000, and there's a few more things on here that we need to look at. Well, really one thing, and that is depreciation expense, which is $27,000. We will need to know that for that is a non-cash expense. So we'll have to add this back to net income. Since we took it out, we'll have to add it back because we didn't really pay this in cash. So our cash, we didn't spend that, so it'll be an increase to cash. We always add back depreciation expense in the operating activities section. But we also have some additional data here, A through F. We have the balance sheet, so we already know our answer to the change in cash. What did it do from 2017 to 2018? It increased by $26,000. Of course, we'll need to look at increases and decreases in current assets, so these two, and then we'll need to look at accumulated depreciation. We know it increased by $27,000, and that is the exact amount of depreciation expense. We also will look at some other things. But first, let's look at our transactions, and let's think about our transactions. We acquired a plant asset of $124,000. Okay, so that will be in another section. That will be in your investing section. Remember, investing is anything we buy for the long term of our company, like an asset or land. Now, if we look at this, we pay $108,000 in cash and $16,000 by signing a notes payable. So the notes payable part is not going to affect cash, but we call this a non-cash investing and financing activity. So what the way the entry for A would look something like this. We would debit plant asset, whatever it is, we'll just call it a plant asset, and we will credit cash and notes payable. And if we go back, cash was, we paid $108,000 in cash and $16,000 in notes payable. So $16,000 here, $108,000 here. So our debit for the plant asset would be $124,000. So that's what our entry would look like for journal entry A. So let's go ahead and look at that on our spreadsheet here. So if we look, I've already filled the spreadsheet out, and all I did was take my balance sheet accounts and put them on here. Here's the beginning, here's the ending. Make sure that total assets equals total liabilities and equity. I didn't do anything but copy these over from the actual balance sheet. And then over here I did the same thing, and I checked to make sure total assets equals liability and owner's equity. These did not equal at first, and I figured out my mistake. I'd put 30,000 here instead of 34,000, so that threw that off. So look, for journal entry A, we debited plant asset and credited cash and notes payable. All right, so that was journal entry A. Give me just a second here. Okay, so that is where, if we look here, go back, that is where our notes payable, 16,000 to 15,000. We'll talk about that in just a second. So we acquired a plan asset, okay? We paid this amount in cash and this amount in signing a notes payable. Now the cash receipt from the sale of land totals 20,000. So we sold land. So our entry would look like this. Cash, we're getting cash and we're going to credit land. 20,000. So 20,000 and 20,000. Okay. All right, then the next one, C, cash receipts from the issuance of common stock total 36,000. So I'm going to debit cash and I'm going to credit common stock for 36,000. Oops. Okay, and then for transaction D, if you look at it, payments of notes payable of 15,000. So we paid off notes payable, so we're spending cash of 15,000. And then let's look at transaction E. Payment of dividends is 5,000. And if you look down here, you'll see that dividends, when we pay dividends, what that does is that decreases retained earnings and decreases cash, because retained earnings is where we get, if we either at the end of the year we either save the cash and it goes into retained earnings, net income goes into retained earnings, or we pay out some dividends. So we don't, if we have enough money left over, we can pay our stockholders. Okay, and then from the balance sheet are these amounts. Okay, so if we look at this, we're going to look at the spreadsheet and we're going to either debit or credit to get these balances to reflect the new balance. So here, if cash went up, to increase cash, we debit cash. So we needed to debit cash by the amount that it changed. So as we see, cash increased by 26,000. Okay, and let me try to get this in order. First of all, you want to put your net income as transaction A, and net income was 53,000. So that increases retained earnings. And then what we want to do is put that on our cash flow statement. And I've already set it up too, where net income is. You want to put the $53,000. All right, so this would be transaction A. Okay, and we're going to put this right here. Okay. All right, so that is A. There's net income. And why we're putting it on the debit side is because we're going to reconcile this to cash. So the $53,000, we're saying this is where we're starting with the cash balance. Okay, and we're going to take that number and go from there. All right, so for transaction B, we're going to go up to the accounts receivable here and do B. And when we look at transaction B, we notice that accounts receivable went from give me just a second. We have to add depreciation expense first. So let's do add back depreciation expense because we always want to do that first. And if we do depreciation expense, that is a debit to depreciation expense and a credit to accumulated depreciation. So right here, accumulated depreciation is what we call a contra asset account. So it is always has a credit balance. So to increase accumulated depreciation, you're going to debit it for $27,000. So $27,000. And the reason it is a contra asset account is because it decreases the value of an asset, a plant asset. Plant asset has a debit balance, so to decrease it, instead of crediting the plant asset, we credit the account called accumulated depreciation. So here we have accumulated depreciation. And down here, we need to add back depreciation expense because we're not really spending money when we pay a depreciation expense. It's not a cash activity. It's not affecting cash. So it was taken out of net income, so we always have to add it back. So $27,000 is added back here. Okay. Now let's look at the next thing we always do is look at our changes in our assets. So we know that accounts receivable went down. How do you make it go down? Do you debit accounts receivable or credit it? Well, it has a normal debit balance, so to decrease it, you need to credit it for $15,000. And we will call this C. Now, what does a decrease in accounts receivable mean as far as cash? That means we paid off more accounts. We spent more cash. We received, I'm doing accounts payable. Accounts receivable means if it went down, we received more cash than the sales we had. So a decrease in accounts receivable means an increase in cash. So for C, it was $15,000. Okay. Remember the little trick I told you for current assets? If it's an increase in a current asset, it's a decrease on the cash flow statement. If it's a decrease in a current asset, it's an increase on the cash flow statement. Just a little trick that I showed you in an earlier video. Do you notice here, if it's on the credit column up here, it's got to be on the debit column down here? Okay,